QuickBooks Pro Plus Desktop 2022 OneNote presentation, purchase and finance equipment. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. If you have access to OneNote, would like to follow along, icon left-hand side, topic introduction 8360, purchase and finance equipment tab. Also take a look at the immersive reader tool. Topic introductions in the text area too, with the same name, same number, but with transcripts. Transcripts that can be translated into multiple languages and either listened to or read in them. Same name and number as presentations as well. Topic introductions designed to give an introduction to the topic, provide screenshots, links where applicable, give accounting background to complement the presentations, and can be used to follow along with them if you don't have access to the software at that time. Closing the icon on the left-hand side, we're going to start off with the screenshot of the home page. We're going through the purchase of equipment, and we're financing the purchase of equipment. This is a transaction that's not happening on a day-to-day basis, and therefore there's not a set form for us to use because these forms are typically designed to handle transactions that happen consistently on basically a day-to-day or repetitive type of basis. Now, if you don't have a form specific to the transaction you are doing, you might then say, well, is the checking account impacted? If it is, maybe I'll use the check register, but in this case it's not, because we're financing the entire purchase of the equipment, so there's no cash that's going to be impacted. That's when you'll typically default to a journal entry, which you can use the registers to do, but you're not going to be using the check register, but rather another register and a balance sheet type of register, or you can use a journal entry. So we're going to be looking at our equipment here on the balance sheet. We're going to be purchasing new equipment, noting that new equipment is usually a larger purchase item. It's going to be dealt with on an accrual basis. Even if you're a cash basis bookkeeping system, you typically have to deviate to an accrual basis because if nothing else, the tax code will make you do it for large pieces of equipment that are going to be purchased. So we're going to be up here on the balance sheet and we're going to be dealing with those accounts up top. As we purchase the equipment, let's go into the chart of accounts. Within the chart of accounts, we can then say what's going to be the loan liability account that we're going to be setting up. We got the one loan that is here. We could use one loan liability account and then have the information related to it for multiple loans be in the form of amortization tables, for example. But internally, I think it's easier to have multiple loan accounts. So you might go into the loan and get more specific with the loan, possibly saying, I'm going to call it like Chase Loan or the name of the institution. That might not be specific enough as well because you might have multiple loans with the same institution. You might put the last four digits of the loan number. I'm going to set it up as an other current liability, which I would do even if it was a long-term loan because there's usually installments, which has a short-term and long-term portion to it. So I'll usually set it up in a short-term type of loan and then break out the short-term and long-term component periodically at the end of the month and or year for reporting purposes. It's going to be a loan type of account. Here it is, other current liabilities, loan payable. So now we got a loan payable account as well. I'm also then going to say we created a loan payable account and then we're going to put our new loan account as a sub account of the loan payable. So the general idea here is I'm going to have multiple loans. I'm going to make one loan payable account. It's going to be an other current liability account. And then I'm going to put the name of my loans from the financial institution and last four digits of the number as sub-accounts so that when I report them, I can report them and give me the detail for internal purposes, for my bookkeeping purposes, and I can collapse them for external reporting purposes if I so choose. So here's what it looks like. We got the loan payable, and then we've got the Chase loan underneath it. This isn't the new loan. This is the old loan that we had before. Now we're going to add another loan, which is going to be related to the actual equipment that we're purchasing here, which I'm going to assume is from Bank of America, which we're also going to make another account for, which is a sub account of the loan payable. So now we've got our loan payable and the two sub accounts related to it. So now we can go into our accounts here and we can basically then add a journal entry. We have a decision. We could go into either one. We could go into the loan payable, or we could go into the fixed asset account ledger and then record our transaction into it because they're both balance sheet accounts and they both have a ledger. Here's the ledger. This is for the loan payable account. I'm actually going to go out to the general ledger, to the journal entry. We're increasing the furniture and equipment and the other side's going to go to that new loan. We want it to go to the new loan, which is the loan payable account of the $5,000. So if I go back to the balance sheet now, our furniture and equipment went up to the 103. We're going to expense it, but we'll expense it in the form of depreciation that we'll have to calculate possibly with the help of the tax software, because that's usually what will help to calculate the depreciation, which we'll talk about later. And then the loan payable down here, we got that drop down for the loan payable. Here's our new loan of the $5,000 and the other loan of the $69,878.13 that we had in the past on the books. If we record this with just a journal entry, it would look something like this. We would just say it's a journal entry increasing the furniture and equipment that we purchased, the other side going to loan payable, which I'm going to call a second loan, add a new loan payable account, furniture and equipment going up to the same amount for both the balance for the year-to-date numbers and the current month numbers, and the liability going up to the current amount for both the year-to-date and the current month numbers, because they're both balance sheet accounts. No impact on the income statement. The income statement will be impacted when we do the adjusting entries, and it'll be recording the depreciation. So here's the equipment account was at the $98,000, up by $5,000 to $103,000. The loan was at 0, up by $5,000 to $5,000.